Welcome to the Real Estate Guys radio program. When you buy real estate, you're always looking for capital. Do I need to have money? Can I borrow money? Well, one of the places people are able to invest in real estate, many don't even know they can. That's their personal retirement account. We're going to talk about how you do that today on the Real Estate Guys radio program.
Hi, this is Patrick Donahoe of Paradigm Life. Wall Street and banks spend billions of dollars per year in advertising with the goal to convince you that they are the solution. But take a look around. None of their advice has worked. The number one concern of all Americans is still money. So are you ready for another way? I've spent the last 10 years teaching people like you a superior way to build wealth and financial independence outside of Wall Street. I've developed a free e-learning program called Infinite 101 where you can learn about the perpetual wealth strategy. In this free program, you'll learn how to build your wealth without a 401k, IRA, or mutual funds. You'll also learn how to establish private financing without ever having to walk into a bank again. These are just two of the many ways this free program can propel you toward financial independence. Simply go to paradigmlife.net and click on the register button on the top right corner of the page to gain instant access.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me, as usual, it's our co-host, financial strategist, Russell Gray.
Hey, Robert.
You know, there's lots of different ways to invest in real estate, lots of markets, lots of product types, and of course, lots of different financing sources.
Yeah, you know, this is such an interesting topic, and it goes way, way back. When we first started working together, we were looking for unique kind of esoteric topics to go out there and add to our real estate education program. And so I did a search going through all these real estate books on Amazon, and I found a book on investing in real estate using your self-directed IRA.
Okay, you didn't really just find a book. Here's some insight into Russell Gray's mind. Most of us, if we wanted to buy a book on real estate, we go to Amazon, we type in real estate investing, and we look at the first, 10, 20, 30, 40 entries. Russ went down like
400. It was 400. 400 books down.
400 books down, and finally found this really unique, really expensive book on investing using your IRA.
Yeah, it was $150. You know, just as a business person, I said to myself, well, you know, gosh, if there's a book for $150 out there and I'm interested in, if I just got my own little IRA, man, I'm probably not going to spend $150 for that book. And if a guy wrote a book and he thinks the content is worth $150, it might have some really, really good ideas in that. But because I knew I could leverage those really good ideas over a larger audience, I'm going to get that book. I'm going to read that book, get my mind around it. And I ended up going to an all-day seminar that the author put on and learning even more, met him, and then we invited him to come out and speak at one of our educational events. And that became a long an interesting journey in working with self-directed IRAs, both as a private investor, as a financial strategist, when I would sit down and look at people's finances and try to unlock the power of their balance sheets, and as a syndicator, because I realized that there was all kinds of available capital out here tied up in investment vehicles that people thought mistakenly weren't available for things like real estate or quote unquote non-traditional investments, which is always a term that cracks me up. You think about it, way before there were stocks and bonds and mutual funds and all of these strange, options and things like that, what existed was real estate, gold, things that were really investments, real assets, if you will. And then somehow we've changed it to where traditional investments are paper and alternative investments are things that are real. And so a lot of people have their IRAs firmly placed in the world of paper, not knowing that they have the ability to put those funds to work in things that are real.
When we first started looking at this subject and had that first seminar, people were aghast. They had no idea you could do that. In fact, I remember you getting a call from a pretty big financial institution in your personal account, and you said, no, I'm not interested in those particular services because I'm investing my retirement funds in real estate. And they told you very, very clearly, oh, no, you can't do that.
Oh, well, I had, I had to have some fun with the guy. So it was a young guy, and having been in the financial services industry, I know what happens. These companies recruit these young guys right out of college. They put them through the company training program, and the only thing they know how to sell or offer or think about or do is what's inside their wheelhouse. So anything outside their wheelhouse doesn't work. So sidebar, if you're out there and you're a real estate syndicator, and you're raising money and you're talking to investors and you're trying to encourage them to take their savings or retirement money, whatever investable assets they have, and put it into real estate, and you think, well, I don't need to study stocks and bonds and mutual funds and all that stuff because I'm not in that space, then you run the risk of looking as foolish to your customers as this guy looked to me.
Right.
Because he didn't know anything what he was talking about. And I said, no, you absolutely can do it. He goes, no, I'm pretty sure you can't. Well, I work for a really big company, he said, and they've given me great training, and I know that you can't do this because if you could do this, they would have told me. And I said, well, I'll tell you what, son. Kind of played the old man card. I said, why don't you go talk to your folks and let them know what I'm doing and ask them to show you why it can't be done, and come back to me with what you discover. Well, I thought I was done with him.
Right.
Well, sure enough, he called me back and he said, no, I just double checked with him. I talked to my supervisor. I talked to one of the senior guys here. I even talked to the company lawyer, and they said, no, you can't do it. And I said, well, then I'm here to tell you you're misinformed. And so we kind of went back and forth and agreed to disagree. But it was really very interesting for me at that stage in my beginning understanding of how to use IRAs. And I think at the time back then when I did the research, there was about $3.5 or $4 trillion of money in IRAs. So it was certainly a pot of money worth trying to unlock. Today, I think it's almost double that.
It's more than that, as we'll learn just shortly. And today, lots of folks are aware of the fact that you can use a self-directed IRA or retirement program of another kind to invest in something like real estate. Today, we're going to talk about not only the ways you do that, but what some of the updates are. We were recently at the Planning for Prosperity event that Glenn Mather puts on every year. And Glenn started this 2-day event with some of the news, some of the updates, some of the changes. And I said, you know what? We haven't talked about this on the radio for a while. Let's talk to Glenn. When we come back, you're going to meet Glenn Mather from New View IRA today on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you've been listening to the Real Estate Guys for a while, then you've heard about the legendary Investor Summit. Simply put, it's the highest level event we do, and the content, faculty, and attendees are amazing. If you're serious about taking your real estate investment to the next level, consider joining us. You'll spend an entire week with like-minded investors, world-class educators, and real-world professionals, and you'll have a blast. It all begins April 1st, 2017 in Houston, Texas. Summit alumni have already booked 60% of the cabins, but public registration is now open. Visit realestateguysradio.com and click on the tab that says Summit to learn more. We spend 2 days on land learning and networking, then jump aboard a luxury cruise ship for 6 more days of classes, roundtable discussions, great dinner conversations, and a ton of fun. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 15th Annual Investors Summit at Sea.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, I'm Robert Kiyosaki, and I encourage you to listen to those wild and crazy real estate guys. They're the best. Been working for years, and they know what they're talking about.
Welcome back to the Real Estate Guys radio program. I'm your host, Robert Helms. This is one of my favorite topics when people aren't sure they have as much to work with as they do. And over the years, we've certainly run into all kinds of folks who have money in their retirement account but aren't really putting it to work like they could be. The gentleman you're about to meet helps people do exactly that. Please welcome back to the Real Estate Guys radio program our Summit faculty member and good good friend Glenn Mather. How are you?
I'm doing good. Great to be with you, Robert and Russ.
It is always good to have you on the program, and it's been a while since we've talked IRAs. It's something you do all the time. You know, I think some folks don't even understand how big of a market it is. There's a lot of money in retirement accounts.
It's kind of scary. I mean, it's last count of $7.4 trillion in IRAs alone. That doesn't even count up the 401ks, 403bs, 457s.
Wow.
It's amazing, the wealth, and a lot of it is generational. We're seeing the baby boomers move in, but a lot of it is because people have been dislocated from their jobs, and so they're rolling over all these employer plans into IRAs.
Well, and a lot of folks, they think of the retirement, it depends on what kind of a plan it's in. If I go work for a company and I have a program there and I had 3 or 4 choices of where I want my money, I don't even think about that. It's taken out of my paycheck, maybe there's matching. At some point, when you make a career change, make a company change, there's this opportunity to roll it over. So for the folks that don't even understand this, there are some nuances and differences between retirement accounts. So when I say retirement accounts, there's all kinds of retirement accounts. There's certain accounts that allow you to self-direct what you do with them.
There are. And as a matter of fact, the IRS has allowed this for a long period of time. Maybe your current custodian doesn't allow it, but you've been allowed to self-direct since 1975. There's actually 4 types of IRAs, but the granddaddy of them all is the traditional. That's the one that we started out with, and that's the account that most people end up rolling their employers' accounts into. It starts there, and then, of course, the Roth is just an amazing vehicle in addition to the traditional.
Well, the Roth IRA, correct me if I'm wrong, because this is my area of expertise, but having seen you speak a number of times, a traditional IRA, you put money into it without paying tax. And then when you pull the money out at the other end is when you pay the tax and you take a distribution in retirement. But with a Roth, you pay tax before it goes in, and then whatever you make at the back end is tax-free.
You're absolutely right, Robert. An interesting way to put this, you pay the tax on the seed instead of on the harvest. And it doesn't really matter whether you're 50 years old and you're putting money into an IRA or you're 30 years old. The fact of the matter is the reason you're putting it in an IRA is to hopefully it grows. And it grows without taxes in either case. But wouldn't you rather pay the tax first and have all the growth happen without any taxation coming out than have it's great to feel like, oh, I didn't have to pay tax on the contribution I did this year. But later on, when it gets really large and you're very excited about your large balance, when you have to start pulling it out, that's a little painful because perhaps you may be in a higher tax bracket than you ever thought you were back 20 years ago.
I hope so. People always talk about, well, you'll have it later when you're in a lower tax bracket. I'm like, you know what? I never want to be in a lower tax bracket. I don't think like that. I want to be in the highest tax bracket possible. And I want to pay as little tax as possible. And one of the tax tools you have is understanding that your retirement funds are treated differently. So it starts with education, and you're great at that. Part of it is that you have to qualify for the Roth. Can you talk to that part of it? Not everyone can open a Roth, right?
Almost everyone can. And it has to do with how much you earn.
Right.
And you have to have earned income. So you can't just getting passive income, let's say getting dividends from your stock. But sweat of the brow work, almost all of that works. W-2 income and a lot of 1099 income, if you're a realtor or a consultant, all of those earnings count. And as long as I've earned $5,500 a year or $6,500, 100% of that, dollar for dollar, can go into your Roth IRA. As long as your earnings, and I don't know exactly what the amounts are off the top of my head, but it's like $125,000 or $130,000. But there's a backdoor way of creating that Roth anyway. So no one's frozen out of that opportunity. It's just an extra step, a very easy extra step if your earnings are too high to directly go into the Roth IRA.
This is what I love about it. There's all kinds of options, and we're not going to get too much into the weeds about it. Just know that it'll depend on your situation, how you earn your money, and how much money you earn, which of the various vehicles you can use. But I think for the purpose of this discussion, if we just assume that folks are able to have a self-directed retirement account, so meaning the self-directed part is that you choose what you invest in, as opposed to saying, hey, my company requires that I pick one of these options. So a self-directed account gives you just a little more choice. Now, there's pros and cons about that. You better choose wisely. You better vet the sponsors and deals and properties and so forth. And we'll talk about in a minute what you can invest in. But that's the mindset, is that you have more choice in what your IRA or other account is invested in.
You're absolutely right, and it can be scary. All that choice can be scary when you're used to basically having 4 or 5 or 6 choices. The average employer plan actually has 6 choices in it. So if you're coming out of that world, you get rolled over into an IRA, a self-directed IRA, it means that not just stocks and bonds and mutual funds, which is what you'd get with Schwab or Ameritrade, but everything the IRS doesn't prohibit. And all of a sudden that list is long. And you absolutely still have that responsibility to vet out the investments and make really good choices.
And this is where you come in. A custodian is involved in a retirement account because you can't have receipt of your retirement funds. That kind of negates the whole thing, right? It's got to be kept separate. And so if you are with one of those companies you named, they're kind of your custodian. In this case, there are specialty custodians that work in the self-directed world. And NewView, that's what you've been doing for a long, long time. What's the nuance of that, of having a custodian that understands this type of investing?
Well, it's necessary. First of all, if you go to those other custodians, they'll probably tell you you can't do it.
Oh, you can't own real estate in your retirement account.
And the fact is you can't if you have them as a custodian, because the custodian is allowed to limit the investment choices. There are a few custodians that believe in giving choice to everybody, which is what we do at NewView, so that your options are almost limitless and those choices are almost limitless. It's a big difference and it's a big change to most IRA holders.
Now, you mentioned the small list of prohibited things. There's certain things you can't invest in and pretty much everything else you can. So it takes a lot less time to talk about things you can't invest in because it's a short list.
It is. There's really three things. Life insurance. And of course, why would you put that in your IRA? Because your IRA is supposed to benefit you.
Right.
And you can't benefit yourself if you're dead.
Probably not.
That makes logical sense. The other is a group called collectibles. So, example, you can't get Yadros and Hummels and baseball cards into your, and there's a small list of what those collectibles are. The third thing is you can't invest into stock of subchapter S companies. Okay. So that's the whole list. 3 items.
Yeah. So pretty much everything else. So real estate you can invest in. Obviously, our listeners, real estate investors, you might look at a property and say, you know what, it's not that expensive. I have that much money in my retirement account, but I have to be careful about how I do it. Your custodian's going to help you, and then there's some rules you have to follow to make sure that it passes muster.
There are rules, and the mustering is really around the relationship of the parties. That's where people tend to get hung up. A couple things. First of all, you as the IRA holder, can't get beneficial use out of the property.
Well, and let's talk about that for a minute, because think about what your retirement account is supposed to be. It's money you put away today, whether it's taxed or not and Roth or not, but it's money you put away today that you're going to need and use in retirement. So you can't have a current benefit. So therefore, you can't invest in property that, say, you're going to go vacation in.
That's right. And kind of think of it like this. Let's put it back into a more conventional framework, Robert. Let's say that you own stock in Microsoft. You can certainly do that with most brokerage houses.
Right.
But next time you're driving through Redmond, Washington, you can't pull into the parking lot and go eat in the employee cafeteria.
Right. Probably not.
Because you're a passive investor, and it's the same with real estate. You have to be a passive investor, which means you can't occupy or get a beneficial use any different than you could at Microsoft.
Great analogy. But what you can invest in is houses, land, apartments, syndications, somebody else's deal. I mean, there's a lot of different things you can invest in.
Oh, my goodness, yes. You mentioned different types of property, but you also mentioned different types of structures.
Yeah.
And so the amount of perturbations between those is almost endless.
Right.
The IRS does not govern which one of those structures you can invest in. You can invest in any or all of those.
In fact, you might decide instead of investing in the real estate, you want to invest in the notes around the real estate. You can invest in notes. You can invest in trust deeds. I mean, there's a lot of different vehicles within the real estate arena. And then, of course, all kinds of things outside of real estate.
Yeah. And it's interesting. People talk about diversification, and I hear that all the time. And, of course, it makes sense not to put all your eggs in one basket. But true self-direction leads you to diversification in so many different ways. So if you like real estate, but you don't want to be collecting rent checks and fixing toilets or dealing with property management issues, you can be on, like you said, on the financing side of it.
Yep.
You can simply go in and finance a first deed of trust. If anything goes wrong with that payment, you now own that property. You can foreclose on it. The IRA can foreclose on it. It can then be resold, or it can be rented out over a long period of time. And your strategies can change over time as you grow in knowledge of real estate. We all start out probably with pretty simple deals, but it doesn't take long, especially if you hang out with the Real Estate Guys radio show, to understand there's different levels of things that you can do. And within an IRA, the nice thing is when you buy and you sell, there's no taxation involved in that.
Well, it's one of the big benefits, and people think differently about their retirement funds. They think, well, that's off in the future, so they make maybe different investment decisions than they might in their own account. One of the things we always urge people to do is to consider the long-term plan for any of your capital. But because of the tool that it is, sometimes it does make sense. For instance, I don't have to necessarily invest in something in my retirement account that has cash flow coming in every month. Because that cash flow goes to my IRA, I can't spend that money anyway. I might pick an investment that's one of these where you put money in now, maybe it's a development project, maybe it's a long-term kind of thing, and there's no money for a few years. That could be harder for me if I need cash flow from the cash in my bank account. But when it comes to my retirement account, it could fit perfectly.
Yeah, it's interesting because I've done a little studying on the psychology of long-term investing, and I'm going to wander off the path a little bit on this. But it's true. You get a huge premium if you invest long-term. Coming in and out, in and out. And I'll tell you one thing, a lot of times in these self-directed IRAs, they are investments that can't easily be withdrawn quickly. And these are the very types of investments that generally outperform those investments that are easily liquid. Sometimes we protect from ourselves, right, when we see a down market. But it also means that those investment choices tend to pay off a lot better down the road. Maybe it doesn't start paying for 3 years or 5 years, but you have all the accumulation in the equity in that property long before maybe the cash comes out.
Now, one of the things is that even though as a custodian of these types of retirement accounts, you don't have a horse in the race, you don't point at investments, you don't vet investments, you do have a compliance department. Talk about that and what you do to ensure that at least the I's are dotted and the T's are crossed.
Yeah, we're really concerned in this business about getting the titling correct. And we have to know what the clear indication is from the client. Sometimes it's a bit muddled. That could be because of the investment advisor not understanding IRAs. And the titling, I'll talk about the exact titling in a minute. But a lot of times it's the client or the buyer themselves not understanding. And what we don't do is we can't book anything unless we understand the structure of it. Our job is not to go in and say this is a good investment, this is a bad investment. But what we can't do is hold it on in the books if we don't understand it. Right. And certainly if the client doesn't understand it. So when we vet it out, we're not vetting it out as to the advisability because the client actually is their own fiduciary of a self-directed IRA. But certainly we want to make sure that when we turn over the records to the IRS once a year, we have to send a Form 5498 to them, that it's clear what the category of investment is. And the titling on it, for instance, if you're going to use NewView, it would be NewView IRA for the benefit of Glenn Mather's IRA. That's how mine's held. So it's actually, Robert, it's actually a trust. An IRA is actually a trust.
And it's like any corporate formality, any of the documents, signatures, and so forth. So you do have to be careful when you say, oh, you get excited about buying a property and you sign the contract in your own name when you're expecting it to be held in your IRA. These are the kinds of things you have to be aware of. Not to scare anybody away. It's totally doable. We have listeners with millions and millions of dollars of their IRA funds holding these kinds of assets. So totally possible. You just have to pay attention to the rules. For instance, it's a great vehicle to invest alongside somebody. A couple of partners. It could be in a syndication, but there's also some prohibited transactions there. There's certain people that you can't do a deal with. Can you talk to that?
Yeah, it's a pretty small amount of people, thankfully. Generally, it starts with your family. Of course, the most disqualified party of all is yourself.
Right.
So we talked about that a little bit earlier in the podcast where we said that if you bought a rental property, let's say on the beach, in your IRA, you're not allowed to go stay in it.
Right.
But there's other people that aren't allowed to go stay in it either. Those are called disqualified parties. So in your family, the expressly is listed in the IRS code that it includes your parents and your grandparents, your children and your grandchildren, their spouses, and your spouse.
Okay.
So, it's interesting. The IRS has never passed on whether if you're living with somebody,
right,
whether they're disqualified or not. It's just better to stay away from doing transactions with anyone with close personal relationships to you. But the IRS has not stated that you can't deal with other people that aren't listed. For example, it doesn't say that you can't deal with brothers and sisters, uncles and aunts, nieces and nephews.
Kind of just a direct line, if you will.
That's
right?
correct.
Okay. So now, here's a question I've always wondered about. You could own a property on the beach in your IRA. You just can't have personal use of it. What about when you retire and you take a distribution? Is there some way that I could use my retirement funds to own a property on the beach that maybe when I retired, 65 or 70. Is there, I don't know the answer. Maybe you don't know the answer.
Oh, I know the answer to
Okay.
this one, and this is really good, and it really amazes me of all the thousands of realtors I talk to about this. What a great tool, especially since I'm headquartered in Florida, and
Right.
we're never more than about a mile or an hour away from the beach, wherever we are in Florida. And this is the deal. Here's how it could work. But it all comes from using a Roth IRA. Remember I talked about the fact that let's tax the seed and not the harvest. In essence, the seed in this case would be buying the condo on the beach. All right? So at that point in time, if you use your Roth IRA, you hold it 5 years, and you're beyond the age of 59. So all during that time period, let's say that you're building wealth, you're getting more and more money into your Roth because you're getting the rental proceeds into the Roth. And of course, any of the expenses like taxes come out of the Roth. But you're still going to build a really nice fat Roth. And then when you say, hey, let's move from Chicago, let's move down to Florida and move into that property, you take the distribution, Robert, and what's the tax implications, do you think?
Well, I would think that if it's in a Roth, then it wouldn't be taxed.
It's not. And what's kind of neat is, so if you can imagine that this property, you bought it $200,000, it's now worth $350,000. If you had not paid tax going in, but had to pay it when you actually converted to personal use and took the distribution, you'd be paying tax on $350,000. Instead, you paid tax on $200,000, and better yet, all of that rental proceeds for those 5 years, maybe that's another $100,000, that also is all tax-free. You could take the property out, leave the $100,000 of Roth income in your Roth, and keep on going.
All right, good stuff. Hey, we're talking today about using retirement funds to invest in non-traditional assets, including real estate. There's some changes that have come down from the IRS and other places. We're going to be talking about those when we come back. Plus, we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2017 Goals Retreat, January 6th through 8th in beautiful San Diego, California. This unique weekend has been called phenomenal, inspirational, and life-changing by the hundreds of people that have attended. Find out more at realestateguysradio.com and click events or call 888-489-7723, extension 18. Get your life back on track physically, spiritually, and financially. Attend the 2017 Goals Retreat on the first weekend of the new year. Click events at realestateguysradio.com to register. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723, extension 18 today.
If you want to retire in the next 5 years or less through real estate, then please pay close attention. My name is Brad Sumrock, and I've taught thousands of my students how to replace their incomes, quit their jobs, and retire faster than they ever thought possible by not investing in single-family homes. You see, there's a secret to retiring fast with little risk, and it has nothing to do with being a landlord, fixing toilets, or flipping houses. The secret is multi-family apartment buildings. Starting from scratch with zero experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job within 3 years of apartment investing. Now, this is not your typical no money down real estate training. We believe in smart, hard work for intelligent people. So if you're good with your finances, have a decent job, or saving your money, and you're looking for a change and getting out of the rat race, then investing in apartment buildings might just be the answer you've been looking for. Send an email right now to sumrock@realestateguysradio.com to get the details of my upcoming training event. And you'll also receive my free training webinar, Apartment Investing for Beginners. That's Sumrock, SUMROK, @realestateguysradio.com.
Hi, this is Peter Schiff, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. I know I'm learning today. I hope that you are. Hey, it's great to talk about retirement funds, whether it's your own retirement funds or whether you are raising capital and looking to help people put their retirement funds to work. Before we get back to our discussion with Glenn Mather, it's time to play Real Estate Trivia. That's your chance to win a prize by knowing today's real estate trivia question. When you hear the question and think you know the answer, simply send an email to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address, because if you're the winner, we're going to send you a copy of Robert Kiyosaki's latest book. It's called Second Chance. That can be yours for free if you know the answer to today's real estate trivia question. Last week we had Sean Gray on the program talking about the millennials, and if you haven't heard that show, definitely go back and hear that one. Here's what we asked last week. Which U.S. state has the most millennials per capita? Well, the answer is the state of Washington, D.C. Right, the 51st state, if you will. Washington, D.C. has served as a magnet for millennials, and over a third of the district's residents fall into that age bracket, more than any other state. Just behind D.C., by the way, is Utah, followed by Alaska, North Dakota, and Texas. Here's our real estate trivia question for this week. Name the longest river in Ireland. What's the longest river in Ireland? That's our real estate trivia question. You can look it up. Maybe you know it. Maybe you have a guess. Either way, quickly get us your best answer to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Be sure and include your name and your physical mailing address so that if you win, we can send you Second Chance by Robert Kiyosaki. That's today's real estate trivia question. We're talking with Glenn Mather from Newview IRA. They're a custodian that help folks navigate this whole interesting way to invest with money that is for your retirement. And Glenn, we were talking before the break about some of the things you can invest in, ways you can invest. And there's been some changes, and some of them are good and some of them are bad. So bring us up to date. What's the latest in your world when it comes to retirement accounts?
Sure, a couple things. Some may be a bit esoteric, but let me just cover 4 or 5 of them.
Okay.
First one is the fact that when you get 70 and a half or beyond, most people do not have Roth IRAs, and it's a shame, although that is slowly growing. The point is that if you have a pre-tax IRA, in other words, an IRA that you haven't paid tax on, when you get to be 70 and a half, the government starts forcing that out. It requires you to take required minimum distributions, and it's their way of finally collecting tax because they haven't collected tax on it before.
Okay, this makes sense. So you've had the money in there, it's been working, it's been growing, and now you're of retirement age, whether you think so or not, 70 and a half, and now you have to start taking distributions, and they're taxed.
That's right. Well, one new rule that was year to year, now it's permanent, is the fact that you can take those RMDs, those required minimum distributions, and submit them to charity. And so they count against it. So in other words, you don't get taxed on them, because typically on the RMDs, they get the tax. But you can go send that money directly to a charity and you're not taxed at all. So a lot of our clients are very charitable minded, so they use their RMDs simply to fulfill what their charitable obligations are.
Well, I love this one because for a lot of folks, they may be thinking at an early age in their 30s, 40s, 50s, they're putting money away because they're going to need it. And then it's not the only investing they have. Perhaps they've got other investing, and lo and behold, they turn 70 and a half. They've got plenty for themselves. And yet, I guess without this rule, they would have to take the distribution, pay tax, and then give the money to charity. In this way, it all goes to charity.
That's right.
That's good.
100% write-off.
All right, up to
$100,000
per year.
Per year. So that really meets the needs of most people's RMDs.
All right, good stuff. All right, that's a positive. We'll call that a positive.
Well, a few other rules, and I'm just going to touch on a couple of the top ones. One is really huge for our industry, and I would say it's huge for anyone that wants to self-direct, because there was a big win for our industry. The Securities and Exchange Commission took a look at the self-directed industry. And the reason they did is there was a couple of bad actors that put together a bad investment and tried to sell it through a self-directed IRA administrator. Well, they don't sell it through the administrator. The administrator takes the direction from the client and places it into the investment.
Yep.
So obviously there were some people that were financially hurt, and they went back to the SEC and said, hey, this company, the self-directed IRA administrator, caused us to be hurt. You know, when we're in this business, we say, well, that could send cold water on the entire industry. And, and obviously that it's the client that are making the decision. The administrator is just booking it, holding the asset, and doing the reporting to the IRS. And after about 9 months of deliberations, they came back and said, No, the client made that choice. The client's the fiduciary. The client is the director of that investment, and the industry can continue on in the way it's doing it. So it was a validation of our industry, but a validation from everyone that's listening to this podcast that you can do this, and the Securities and Exchange Commission does not view this as a dangerous or an illegal activity.
Excellent.
So that was just a really good thing for us.
Yep.
The other thing was that some of our clients would have more than one account, and there's called the way you move money from one account to another. We talked about this before. We called it a rollover. So if it goes from an employer plan to an IRA, It's called a rollover. There's two ways, Robert, you can have that happen. You can just have one custodian transfer it to the other. By far the best.
Yeah.
Because if anything happens, it's on one custodian or another. The other way is you can actually take the money out. So I can take the money out of my 401k if I sever service with that company and actually hold it for 60 days. I can put it in my checking account. I could go to Las Vegas if I wanted to. But I have to have it by day 61 into another IRA, or else it's a withdrawal, and there could be penalties, and there certainly would be taxes involved in that. So people would play this game. They'd open several of these accounts, and they would take it out of one account for 60 days, put it in another account for 60 days, because the IRS was very unclear in their rulings, and it seemed to say that each account, you got to do that once every year.
Okay.
Well, they closed that loophole and said one indirect rollover per year. And by the way, for those of you listening, don't worry, don't get confused. A transfer from one custodian to another can be endless. You can keep doing those things. It doesn't matter. But it's when it touches your own hands. And I would ask the audience not to let that money touch your own hands unless you have to.
Right.
It's much safer not to do that.
Yeah, good point. Now, on that point, imagine you did that and you took money out of the account that the custodian has it in, and you took the receipt, and now you went to put it with your new custodian. It would have to be the exact same dollar amount. Could you add to it? With that in contributions? If you don't put it all through, that's taxed. I mean, how does that part work?
Well, the way it works is whatever the amount was that left the old custodian needs to be the same amount that comes to the new one.
Yeah.
If it's less, you'll just get taxed on the difference. You can't put more in until it's there, and then you can make the contribution. So it kind of has to come all over. Account opened, account funded with the old balance coming from the other administrator.
Yep.
And then you can add through contributions. Yes.
All right, good stuff. What else? What else is new?
Well, a couple other things. What we're seeing is, and I don't want to call it alarming, but it's kind of a whiff of something that's out there. I don't know if your listeners know, but there's a bit of a deficit right now in our country.
We've heard something about that. Yes.
Yeah.
No, I don't know, 19 or 20 trillion. Not a lot, but...
You know, it's really funny because we talk about decimals because we say it's 19.4, like the 0.4 is small. The 0.4 is 400 billion.
Right.
So it's rolling up. And I think
400 billion there, 400 billion there, it starts to add up.
Yeah, it really does. And it adds up quickly, unfortunately. And there's no real appetite to stop it. But one day we're going to have to fund this. And we're going to have to fund it somehow. So what we've seen is we've seen two new IRA derivatives come out. And unfortunately, both of them are funded into U.S. Treasuries.
Yeah.
So that should kind of give you pause. One is called the MIRA or My IRA. That was introduced a couple years ago, and that is for sort of a beginning savers account. But there's another thing that came out, and that actually the first one goes into play in California in a few months, and it's a state-sponsored IRA. That one is really interesting because it's also for smaller employers being from 5 to 100 employees. And what it means is that if you work for those companies, you go to work for those companies, you actually get automatically enrolled. So you have to opt out. So most people will be enrolled, and then they will be as little as $5 a pay period. It can be much higher than that. But I think the bad thing about this is it sets the precedence because the trustees that are appointed by politicians, can you imagine the investments run by politicians?
Right.
They're going to make that decision where it goes, and according to law, for the first 3 years, it's going to go into treasuries.
Right. That's a clue, right? That's just a clue. So not getting political, any of that. Here's the thing. Nobody cares as much about you and your money as you do. And right behind that is the government. So when the government is looking to not only control your funds, but deciding where they invest, and that might be okay with you, and if it is, awesome. But what the advantage of a self-directed account allows you to do is you make the decisions of what you're investing in. And you may have a different risk parameter in your personal investing than you do in your IRA. Some people take more risk in their IRA. Others are more conservative in their IRA. That comes down to personal philosophy. But you need to think through this stuff because it's going to have an impact on you eventually.
Oh, yeah. And it's interesting because I think people really discount the value of an IRA. They discount the fact that even if you're in a pre-tax IRA, a traditional IRA, the benefit of having all those gains continue to compound and continue to compound. You know, Robert, what generally happens is you go make a deal. You might make $5,000, $10,000, $100,000 on the deal, and then all of a sudden the tax toll gate comes down. And I will tell you, even long-term capital gain rates have gone from 15% to 23.8% in some instances. So all of a sudden you're stripping out almost a quarter of your gains to start your next gain with an IRA. Even if it's not a Roth, those gains continue to keep piling up, and it's so powerful. And I really worry about people underestimating the power of this, and I appreciate the fact that you're sharing this with your listeners.
Well, you know, Glenn, one of the things that occurs to me is people think that they really shouldn't even bother unless they have a big chunk of money to invest. But in reality, you can invest with a very little amount, and most people start kind of humbly and modestly with their IRAs. And in fact, the limits that are imposed typically of how much you can put in, right, it's a thing that's designed to grow slowly over time. And so I think one of the things I would urge people is it's probably never too early to think about opening an account like this.
Oh, no, not at all. I mean, the real power is if you can't figure out what to invest in, there's someone else out there that's already figured it out. So why not partner with them? You can partner with them with $1,000, $2,000, $3,000. And Robert, what I find astounding is this, is people will talk to me, and I talk to thousands of people a year on this, is they'll say, I'm going to wait until my IRA is large enough, so I'll keep it in the stock market until it gets large enough to self-direct. I'm saying, wow. That's kind of interesting because, in my opinion, it's going to grow a lot slower through someone else making decisions for you than you making decisions. So why not ride with somebody else successful? But there's other things you can do. You can lend money. There's people that want $1,000. There's people that want $5,000. Look at all these payday stores. They do small amounts, and they're charging 15, 17, 19%. You can do that with your IRA, and if there's any fees involved from the administrator, you can make the borrower pay it. So you're talking about being able to compound far more quickly, even with small amounts in a self-directed IRA environment than you ever can in the market.
Well, and let's talk about the fees for a minute because people may be wondering about that. In my mind, they're so nominal I don't think about them. But a custodian that allows for self-direction, like NewView, that's how you earn your money and pay your employees is through those fees, which again, for most people, they're fairly modest. But you might look at that compared to what your employer plan is and say, well, it's more expensive. But it's compared to what, right?
Well, I mean, and let's be fair, those employer plans, they're stuffed with fees, but they come out of the yield. So you don't see it, so it's not on top. Our fees are $50 to open the account, $95 when you make that investment. Let's say you buy a piece of property in your IRA, it's $95. Then it's $295 a year to hold it for the whole year and, in essence, do all the reporting to the IRS because there are some blocking and tackling that we have to do. So you kind of think about it, and by the way, if you're sitting in cash and you don't know what to do, we only charge you $195 a year to open up a checking account that has the full freedom of a self-directed IRA. Can you imagine that? It's a checking account that you simply tell us to spend the money. We spend the money on what it is you want to invest in. So that power, a lot of times people will say, well, I'll wait until I find something, especially in real estate. That's too late. So one of the coolest things you can do is open up an account, open it up with only the amount of money you need for the good faith deposit. Does that make sense, Robert?
Yep.
So you can actually go shopping, right?
Yep, absolutely.
You can always move the rest of the money over once you're under contract.
Sure.
And so that's been a real effective tool for us to get people to be aware of what they can do. And once you understand what a self-directed IRA does, you can't wait to go shop for investments.
Absolutely. Well, this is great stuff. We could go on and on, but we don't quite have the time. A couple of great resources. First of all, you're coming back on the Investor Summit at Sea next year?
I can't wait. I mean, I think this is year 4. I can't wait.
So you can have an entire week with a bunch of amazing folks and picking their brain. And if you have any IRA questions, you can sit down with Glenn. He's happy to answer those questions with you and so forth. Also, we've talked today mostly from the point of view of your retirement account, where you would invest. At our Secrets of Successful Syndication, you often come out and teach the other side of it, which is to teach people looking to raise money how they can put these types of assets to work.
Oh, yeah. I mean, keep in mind that most people that have had IRAs and 401ks have never had anyone sit down with them and discuss it. And can you imagine the power of someone who has a great investment to be able to sit down and say, hey, you can do this in your IRA? Remember, we talked in an earlier segment about the value of having something that's non-liquid, that's something that you can hold on to a long period of time. I find that my friends that have money find it to be a burden, believe it or not, Robert, finding good opportunities. So syndicators or people that are raising money, there's no better money to go after than IRAs because you get a chance to talk to people and that money's long term. In the final analysis, you're doing them a big favor by giving them these options that they never knew they had.
And finally, Glenn has some great information actually on our website. If you go to realestateguysradio.com, under our resource center, you'll find out there's a lot there. And you guys continue to do education and helping bring people up to speed on that, and love that. You teach first. We love that. So as always, it's been great to get updated, and thanks for all the information today.
Thanks so much, Robert.
There you go. That's Glenn Mather from New View IRA. We'll have more to talk about when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Are you ready to profit in paradise? Hi, it's Robert Helms, and if you think real estate investing means tenants, toilets, and termites, think again. Located just a short plane ride from the U.S., a virtually untouched paradise awaits, the beautiful country of Belize. When you go to Belize with the Real Estate Guys, you'll spend 4 fabulous days discovering one of the most intriguing real estate markets I've ever seen. With its jungle rainforest, pristine beaches, and 81-degree turquoise water, Belize is one of the most beautiful places on earth. Plus, it's considered one of the top 7 tax havens in the world. Belize property is on the rise, and many experts think the best is yet to come. But don't just take my word for it. Come experience Belize firsthand at our upcoming investor field trip. When you join us, you'll discover the many reasons we love Belize, like tremendously undervalued beachfront land, super low taxes, ease of doing business, and so much more. Get the details at realestateguysradio.com. Just click on events. See paradise for yourself. Click events at realestateguysradio.com, and I'll see you in beautiful Belize. Memphis is famous for being the home of the king of rock and roll, but it's also the king of cash flow. If you're looking for affordable cash flow properties, it's hard to beat Memphis. Get your portfolio rocking and more cash flowing your way by calling Terry Kerr at Mid-South Home Buyers. Terry's the king of turnkey properties. Contact Terry through the resource section at realestateguysradio.com. And be sure to order Terry's tips for turnkey rental property investing report. It's free. Just send your request to turnkey@realestateguysradio.com.
Hey, this is Phil Collin from Def Leppard and Delta D. You're listening to the Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Always great to get updated by Glenn Mather. There's a guy that's pretty passionate about what he does.
Yeah, I love the way he started the company, you know, having been a corporate guy with an IRA and then leaving his job and realizing he could self-direct and wondering, gosh, why doesn't everybody do this? This is fabulous. And actually building a company to go out and provide the very service that he felt that the world needed. And, you know, really that's the essence of entrepreneurism. So it's great when you get a chance to work with a guy or deal with a guy who does what he does for the mission, for the vision, for the values, for the passion, and not just for the money. Great guy. And, you know, the thing is, like at this Planning for Prosperity event that was great, he's also a pretty charitable guy. And I really like that about him. He runs a fine organization, and we've had a chance to work with him quite a bit over the last several years.
Absolutely. He speaks a lot. He educates a lot. You know, a big part of his business is making sure people understand what they can and cannot do with their investments. We touched on a lot of that. Glenn has the report available that all you have to do is actually send an email to iraguide@realestateguysradio.com if you'd like us to send you that for free. iraguide@realestateguysradio.com. Give you some more ideas. But I also appreciate the fact that he's staying up to date. He's staying on the cutting edge. I mean, when we hear about a change when it comes to this area, it's usually him. We hear it from first.
Well, this is the key. You know, we talk all the time. You can't keep up on everything yourself, even though everything that's important to you, you should be setting news alerts for and paying attention to. But there are people in specific segments that eat, drink, live, breathe, sleep a particular area of financial services, financial industry. And, you know, Glenn is one of those guys. And so you're going to want to have people like that on your team. And of course, this development with the whole Myra thing, and it's been a concern, and it's always a concern. You always have to be wondering, if and how a revenue-starved government may be making moves towards your assets. We talk a lot on this show about inflation, and really inflation is generally a wealth transfer. We do talk quite a bit about taxes, and ultimately IRAs are kind of like tax. From time to time we talk precious metals. You know, anybody that really studies precious metals knows that there was a time in history when people owned gold and it was money and it circulated as currency, and then the government took it away. And for decades, you were not allowed to own it at all, and it basically gave the government a monopoly on owning gold and things they could do with the currency. Later on, that was revoked, and now people have the opportunity and the ability to buy gold, even though a lot of people don't understand it. The point is that things change, and sometimes the things change are opportunities to make money. Sometimes you have to be paying attention because you need to reposition yourselves to get away from a potential risk. Not saying anything's going to happen, but as Simon Black often says, if you can see the threat potential and you make a preemptive move to protect yourself and nothing happens, how are you worse off?
Well, this is the big picture when it comes to talking about your retirement account and your retirement funds. That's money you set aside for later. And so, as we've been talking about today on the show, we always don't think about that the same way we do as our other sources of capital. And it's really like that with our life. How do you step back and plan your next 10, 20, 30, 40 years? A big part of that's financial, but there's more to your life than just finances. Coming up at the first weekend of the year, we do our Create Your Future Goals Retreat. It's 2.5 days spent in a beautiful, beautiful location, San Diego, California. This is a chance for you to get in touch with all the areas of your life that matter and to really chart a new course.
Well, if you think about it, if you were going to build a dream home, the home that you're going to spend most of your time in, live in, raise your family in, maybe even die in, if you're going to do that, you're probably going to sit down and think about how you want it to look, what it's going to be like, how you want it to be decorated. You're going to maybe get some professionals involved who are going to help you with an architectural scheme and an engineering and landscaping and all the things that you have to do. And you think about it, you know, the old adage is people spend more time planning a 2-week vacation than they do planning the rest of their life. Certainly, if you were building a dream home, you would spend quite a bit of time. What is more important than designing the life that you're going to spend the rest of your life living? And it's just shocking to me how many people abdicate that and just turn it over to the winds of chance. And if a good idea comes along, they wouldn't know if it was good or bad for them. It might be good for the guy next to you, but maybe not good for you. So the point is, you can live your life by default or you can live your life by design. And the thing that I love about this particular event, Robert, the way you do it, is it's not up you telling people what they need to be doing, but it's you asking them questions and putting them in a frame of mind that they can give themselves honest answers. Simon Black often talks about a brutally honest self-assessment.
Right.
And it's this notion that you've got to be honest. It's like when you sit down and look at your financial statements, they say a lot about you, your business, your money management skills, your habit, your disciplines. You may not like what you see, but it's going to give you that honest assessment. Sometimes when you sit down in an event like this and you ask yourself these hard questions, things come up that are scary. You're like, wow, I didn't realize I've completely obligated myself to a career, a line of work, maybe a relationship, maybe a certain kind of lifestyle. And it is not really making me happy. It isn't really adding value to the world. It isn't really congruent with my true self that I'm beginning to understand more because of this process. And you go ahead and reinvent your life. And that's why you don't just do it once. You come back every year and you do a reassessment. So if you've never been, or if you've been, but you haven't been for a while, I highly encourage you to make the investment of the time and the money to be in San Diego at the beginning of January 2017 and go through 2.5 days that are absolutely magical if you will bring your A game and go through the process.
All the details on our website at realestateguysradio.com under events. Big thanks to Glenn Mather for sharing his information, wisdom, and update with us today. Next week on the Real Estate Guys, we're looking out at the horizon and saying, wow, cap rates are down, harder to find good deals today. Is it still possible to find a great deal in a strong market? That's what we'll explore next week on the Real Estate Guys radio program. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct.
Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.